Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Volatility Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Volatility Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital.
Hey guys, this is Justin. When we started doing interviews on excess returns, we wanted to come up with one way to boil down the best advice from the experts we interviewed into one simple question. That led us to create a standard closing question that we ask all of our guests, which is, based on your experience in the markets, if you could teach one lesson to your average investor, what would that be? Over the history of the podcast, we've had a wide variety of guests on, ranging from great investors to academics who have spent their careers researching what works in the markets, to options and macro trader and experts. In this episode, we bring together all of their best advice into one episode and offer all of their answers to our closing question. And stay tuned until the very end when Jack and I and Matt Ziegler, who co-hosts the Education of the Financial Planner podcast with us, provide our answers to the question for the first time. So without further ado, here are 70 investing experts coming together to answer one question. What is the one lesson you would teach the average investor?
So we talked a lot about dealer positioning already. I think that's the biggest takeaway, right? That's part of why people kind of follow me and are interested in kind of what we're talking about. But the other day, like I mentioned, that's one part of one critically important thing, the only thing, which is supply and demand. I think so many people just lose sight of that simple little thing. How many buyers are there and how many sellers are there? We obfuscate this by thinking about second order factors like fundamentals. Fundamentals matter. The cash flow of the corporation is part of that supply and demand. But we lose sight of how many buyers versus sellers are there ultimately. We should never, ever lose sight of it. And I guess my corollary to that, and what I'll leave you with outside of that, is liquidity. That word is everything. Liquidity can mean the thing that spurs demand and that creates enough liquidity to keep it going. It can also mean the removal of it, right? Is there isn't enough demand or there's not enough money to go around. But it's also important to think about when you're trading and you're positioning, how liquid you are and how liquid the things you're investing. Ultimately, it doesn't matter how much demand there is today or tomorrow for something that won't ultimately have liquidity at some point. It doesn't matter what its earnings are if it doesn't have access to markets. That's true in the option space as well. That's true in derivatives and everywhere. When you invest in something or you put a trade on, you better believe liquidity. You better be in a position of strong liquidity, particularly in a period like this. There's a reason the word long-term is in long-term capital management. I can't stress this enough. Long-term capital management blew out because they were short puts that were long dated against things that are short. They were short illiquid things versus things that were liquid. If you position yourself in a place of illiquidity, particularly as a period of lack of liquidity in a leptocurtic market with fat tails, which is what we're in right now, you will ultimately lose. And no matter how good the bet looks, no matter how cheap something may seem, you will be in a position of lack of buyers versus sellers. And when you get to that point of a lack of, buyers versus sellers, and you're on the wrong side of that, you will lose a lot of money. So never lose sight of supply and demand. Always understand your liquidity point, and always think of it in terms of the amount of money that is available at any given moment to fund supply and demand.
I think that I would encourage people to learn about and apply base rates as they think about the world of investing. By the way, it's not just valuable for investing, but really business or your life. Actually, it's good for your life. And again, a base rate, the basic setup is the natural way to think about the world or solve your problems is to gather a bunch of information and combine it with your own inputs and experience and project into the future. And that's what we all do left to our own devices. Using base rate says, I'm going to think about what I'm facing now or my problem as an instance of a larger reference class. I'm going to basically ask what happened when other people or organizations were in this position before. And it's a very unnatural way to think because you have to leave aside, sort of your own information gathering and your own experience. We all tend to place a lot of value on that. And you have to find and appeal to the base rate, which may not be at your fingertips, and often it's not. So you have to go out and make a little effort to find it. But once you do, I think it reshapes how you think a lot about the world. And I think makes you more grounded in terms of how you think about how things are likely to unfold. So to me, if that would be the one idea, is to say, let's think about base rates. You mentioned before jokingly that we're in that sort of season where people do forecasts. That's a great example where base rates would be very helpful. And you sort of made the joke 10% with some standard deviation, but that's actually the right way to think about it. That's actually the right answer. And that's informed by base rates. So you got to the right place and the right way to think about it using that actual technique. So to me, that would be the one bit of advice I would give. And if I could go back to my 20-year-old self, that's certainly what I would teach. And by the way, I would just say that it's remarkable how underutilized this concept is, notwithstanding its demonstrable power, right? So anyway, that would be my concluding thought.
Well, I was going to say base rates, but Malcolm Mauboussin already stole that. But the problem is I was stealing it from him because it's from his books. But I do think an outside view would be one. But let me try to use the semantics of your question to make it a little more interesting. You specifically said the average investor. So my one piece of advice would be recognize that you are average. That's a very hard thing to say. And it's hard for anyone to admit. But when you are up against, nobody would go swimming in the Olympics in a couple of weeks, thinking that they could win up against Olympic swimmers, right? You are even an average swimmer. Now, you could do something different. You could challenge that Olympic swimmer to a game of poker, and your odds might be much better. You could play let's pull it back to the stock market before I stretch this analogy too far. But, you can find a niche, but that where you think you can win. And that can be because, your investment horizon is different. Some of the institutional frameworks of the market is different. You can find something in less liquid stocks. But if you recognize that you are average and how hard it is to outperform, I think it leads you to two decisions. You either let the professionals run it or you index, unless you really can find a niche. If you can find a niche, that's wonderful. Please.
So, yeah, I've thought about this a lot actually since our last talk, because I figured you were going to ask me this. And the one, to boil it all down to one thing, it's to understand that markets are a political utility, and that, there's this old story, traveler comes in this old west town and he sees these guys playing poker, and he sees that the dealer is obviously cheating. And he talks to one of the players later and says, well, what are you doing? The guy's cheating. And the guy says, yeah, I know, but it's the only game in town. Right? The stock market, the public market, it's not the only game in town. That we should be trying to connect our investments with the real, not the casino, not the stories that are told to us. We can play with it, right? And I think you should invest in a market. If you're going to be an investor, you're looking just to harvest the political utility nature of markets. You're just trying to harvest the beta. But if you're trying to find alpha, you're trying to make an investment, you want to make money, you find something that's real, that's close to you, and where you're not being told a story. That's the advice I've got. You know what it's actually like? It's like the old Peter Lynch. You remember Peter Lynch, right? Where he always said, what do we do at Magellan? Oh, we really invest in real companies. And I don't know, maybe that was possible for Peter Lynch, back in 1978. I don't know, maybe that was possible for him. It's not possible today, not in public markets. You want something real, you want to invest in your own company, your own self, invest in something that you can understand. And that doesn't exist in public markets today. I'm not saying get out. You use them for their political utility nature. You harvest the beta, you stick it in a drawer, and you forget about it. But you want to be an investor, you want to do research, you want to try to make alpha. It's got to be in something real. It's got to be something close to you. I don't think you can find that in public markets today. That's the one thing I'd try to put across.
I think there probably is no perfect way to save and invest. There's no top 10 list you can read, or there's no book you can read that's going to like completely change your life and make it easier for you to figure it out. I think you just have to kind of pick a strategy and then stick with it come hell or high water, because I think one of the hardest parts is these days we can always see how other people are saving and investing, and this person is investing in this. And I think it's probably never been a better time to be an individual investor in terms of the strategies and products and tools we have available. I mean, if you think about some of the strategies that are now offered in a tax-efficient ETF that were only available to rich individuals or institutions or hedge funds back in the day, and individuals can now use these same strategies for pennies on the dollar in terms of costs. That's a great thing. The problem is there's so many choices these days for what you can invest in that it makes it much harder for people to stick with a strategy. So I think for most people, the good strategy you can stick with is vastly superior to the great strategy that you can't stick with. It's just really hard for people to find that one strategy and stick with it. So I think that's kind of the lesson I'd impart on a lot of people, is just if you find a strategy that works for you, don't worry what everyone else is doing and just stick with your own strategy and call it a day.
Yeah, I mean, it would be diversify, right? It would be humble about what you know and what you can know, and don't be over-reliant on what you observed in the past. The past is one sample draw from an infinite variety of potential sample draws that we might get in the future in terms of combinations of inflation, growth, geopolitical risk, supply-demand dynamics, technological shocks, etc. And the future is probably going to look quite a bit different from the past. And so the best way to prepare for the unknown is to diversify. So I think that would be my core message.
I think you need to write down what you're doing at the time that you do it, because it takes, if you're a fundamental investor, it takes years really to work out whether the decision that you made actually resulted in the outcome that you thought. And the only way that you learn is by looking at outcomes against decisions. And it's so easy to forget why you did something. And really the worst case scenario, as funny as this sounds, but the worst case scenario is when you get the stock goes up, but for a reason that you didn't identify. So you got lucky, but then you start conflating that luck with some skill. And I think that you need to be intellectually honest with why you did something, and you need to recognize those things. You need to recognize the ones that won, but you were wrong. Recognize the ones where you lost money, but you were right. And you need to try to work more towards the process and getting that right than relying on the outcome and deciding that you were right. So that's my advice. I've always said this, write it down. Because, I've got stuff now that I wrote down in 2008. I can go back and look at it and I think that's garbage, but at least it's there and it's written down, and I can see that there's been some evolution over the last, whatever it is, 13 or 14 years.
The answer is find a portfolio you can live with, manage it passively through time, and don't think you have an edge, because you probably don't.
I think what I always try to impart on investors is that predicting the future is really, really hard. It's nearly impossible. Now that might sound odd coming from a person that has spent his living trying to predict the future. But the future that I'm talking about is the one where you're trying to predict what's going to happen over the next 12 months to any single asset class or security at any time, right? The type of prediction that we do internally is incredibly competitive, and I'm trying to predict using multiple factors what's going to happen in the next 5 to 10 trading days. So I need a full team, and I need to be active, be able to create that alpha, and it's in the most competitive landscape in the world. So what I try to tell people is, if you don't know for sure that you have an edge, that you are understanding that you're competing with the brightest minds on the planet in the most competitive landscape, if you don't understand that, then you're in trouble. And you should internalize that in my view, the way to approach the problem of saving for retirement is that you need to have an understanding that diversification is the first place to start. It is an explicit recognition of our ignorance. And of course, the way you need to both diversify for different market environments, high inflation, low inflation, high growth, low growth, but you also need to make sure that you put those components in balance so that the maniacs aren't taking over the asylum, where you're not having high volatility stuff, tail wagging the portfolio dog. So I think balance and diversification without making any future prediction is your first step. Like, you need to get that right. You need to internalize why diversification works and why it's important, and stop trying to predict or believe in anybody that's trying to give you predictions of the future. Once you have that in place, then you can start testing how good you are against the rest of this competitive landscape. I think that's step one, whereas the opposite tends to happen. People come into the market, they have Dunning-Kruger effect. They have one win picking a stock, and they think they got it. And as the more they play this game, the more they realize they don't have it. And a decade later, they said, well, diversification is the way to go because I can't foresee the future, right? So we got to flip that. Focus on diversification first. Create a do-no-harm portfolio, the Hippocratic portfolio of finance, and then start trying to edge out some alpha.
I think my sentiments will echo Rod's, though I'll take it in a slightly different manner. I would say that I think a lot of people try to find alpha in security selection. And I think there's a lot more alpha to be created over time in portfolio structure. And it can both be offensively through ideas like return stacking, but also defensively in terms of how you create a resilient portfolio. We're only going to live one path of market history. We never want to realize catastrophic losses. So Rod just spoke very eloquently about building a resilient portfolio diversified across economic regimes. The way I've always thought about it is there's really just more than one dimension of diversification. We often think about what I call the what dimension, as in what are we investing in? And I think that's a crucially important dimension of asset allocation. But I think we should also think about how those investment decisions are being made and when they're being made, right? If you got your asset allocation correct, but you put all your equities into deep value stocks over the last decade, you've sort of lagged behind equity markets. So your how decision wasn't necessarily well diversified. Similarly, that when you rebalance is sort of an opportunity diversification. If you happen to have private equity in your portfolio, for example, and you just allocated once in 2013, it might have been a good vintage. It may not have been. Similarly, when you rebalance your portfolio has a huge amount of impact. So for me, creating portfolios with true resiliency is not just thinking about the economic diversification that Rodrigo pointed out, though that is crucially important. It's also thinking through these other axes of diversification.
Valuation doesn't work under 1, 2, 3 years. 3 years and beyond, you typically start to see valuation have a material influence on financial markets. But generally speaking, something can remain over or undervalued for several years before it really starts to get influenced again by some of those positioning dynamics. And I think it's like that with econometric models as well. I mean, I've seen that so many of these charts where the author finds this one time series and overlays it with another time series, and the one time series that leads the other time series by 12 to 18 months is already in place B, and it implies that the time series B has to go to place B over some duration, and they say, oh well, I'm bullish or bearish as a function of that. Well, doesn't it imply that there needs to be 18 months of time to pass between us getting from point A to point B, right? I mean, I think that's the one thing that I think it's kind of lost when we see these pretty charts. We see pretty valuation setups, or pretty anything in financial markets, which is it takes time for those things to be realized, understood, appreciated, and priced in. It's often several months, several quarters, if not a few years of time.
One I've already mentioned, which is don't confuse information with knowledge. That I find is one of the worst mistakes. But the other would be this, since we covered that one. It is my experience. Well, let me say it this way. Any good financial economist knows that all risk assets, any strategy involving investing in a risky asset, will go through very long periods of poor performance. For example, there are 3 periods of at least 13 years with the S&P 500 underperformed totally riskless treasury bill. From 29 to 43, that's 15 years, 66 to 82, 17 years, and 2000 to 12, that's 13 years. That's almost half of the last 93 years of data that we have. And yet, if you held on, you got 10% a year. But if you panicked and sold, you did. And that's a problem. Now, maybe people hold on when they think about stocks, but we know many people panic and sell. But if you don't panic and sell during that period because you're smarter than that, you've built a plan to withstand it, why do you panic and sell when value does underperform for 4 years? Or reinsurance has 3 bad years from 17 to 20. Or AQR style premium had a horrible period for 3 years or so because we had a 5 standard deviation event where value had a bigger, growth had a bigger bubble than it did in the 90s. People panic and sell because they think 3 years is a long time when it comes to judging performance. 5 years is a very long time, and 10 years in an eternity. That literally is nonsense. And what that tells you is, since any risk asset can and will go through long periods of underperformance. Here's one other. Gold from 1980 to 2002, this supposed inflation hedge, underperformed inflation by 86% over 23 years. Every risk asset you can think of goes through such periods. So what should you do about that? There's only one logical thing you should do. Since you can't predict which will do well when, all the evidence says active management fails at doing that. You want to diversify, of course, as many unique sources of risk as you can identify that meet the criteria Andy Birkin and I put in our book, Your Complete Guide to Factor-Based Investing, meaning that it has a premium, it's persistent across economic regimes, long periods of time, it's pervasive around the globe across asset classes, it's robust to various definitions, so value works, whether you use PE or EBITDA or cash flow, momentum works, whatever the formation and holding periods are. It's implementable, meaning it survives transactions costs, and there are logical risk or behavioral reasons why you think the premium should persist. If it meets those criteria, then you should diversify across them so you don't run the risk of all your eggs being in, say, a beta basket. And here's the final example to make that point. 40 years, 69 through 08, both large cap and small cap growth stocks underperformed the 20-year treasury bond, which is the totally riskless asset for a long-term pension plan with nominal liabilities. That's 40 years where growth stocks outperform, and you abandon it, and then you miss out on the great returns you got after. So why would you abandon value when it underperformed for 4 years? Or reinsurance when 3, or a long-short value, long-short factor strategy underperformed? That's why we diversify, rebalance, and stay the course. That's the lesson.
Know thyself. This is an incredibly hard business. We're always dealing with limited information. We're going to be wrong a lot in what we do. And just, it's okay. You're going to make mistakes. You're going to try things that don't work. But don't turn away from the mistakes. Stare at them. Try to figure, why did you do it? If there's one guy to listen to in this, you've got to listen to interviews with Stan Druckenmiller. That guy was obsessed with behavioral finance before it was a thing. Why did he do it? He couldn't resist, and he's brutally honest with himself. And I think that in this business in particular, when we're dealing with all of these things, it's just a framework for thinking about how you make decisions about things. And it's hard to do. Sometimes you discover things about yourself that you wish weren't true, but then you can work on it. Better to know.
Sit on your hands, right? Come up with an idea. Think through your strategy or your process, or how you think investing should work. There's going to be noise. There's going to be FOMO. Stick to what you believe in, and try not to react to the market too much. I think you could run yourself in circles reacting to the new hot thing that pops up every every couple of years, right? You could take your whole portfolio and put it into Bitcoin and then put it into ARK and then, who knows what's going to be next, but put it into that. And really that's going to cause you a lot of anxiety, cost you a lot in turnover and transaction costs. And at the end of the day, probably lead to a worse outcome.
The older I get, I feel like the more I realize, the less I know about all of this stuff. And so it's this weird sort of journey in finance and economics where, you typically think that like the old guys are the ones that know everything. And the more I find myself becoming an old guy, the more I just sort of have realized how little I know about all this stuff because it's so friggin' complex. And so, I would say that one of the mistakes I made when I was younger was just pigeonholing myself, whether it be inside of like certain, political cliques or whether it's even like certain strategies where you can find yourself in attracted to like a very specific niche type of strategy. And what you'll find is that you could go through really long periods of time where that strategy doesn't perform well at all. And so to me, being super open-minded, not only on the political side, but on the economic and finance side, and especially on the investing side is really important just because you have to be positioned in a way so that you can kind of navigate all environments. And that's, I think to a large degree, it's why I've become very attracted to like all weather portfolios, because I kind of know that I don't know what's going to happen in the future. And I want to a certain degree, at least with a big chunk of my assets, I want to diversify so much that I've always got components of my portfolio that are weathering any type of environment. So yeah, being open-minded to me is like a superpower in finance and economics.
Paul basically believes that you should look at your portfolio like you just put everything on that day. It's don't get too complacent because, I've got this position and I'm well ahead. I don't have to worry about it. It's like a thing. Question is, if you just put this position on it today, would you be comfortable with it? Or would you be comfortable with it where your risk point is, So having that mentality of not getting complacent and viewing every position, not how is it since you put it on, but how does it look today? Would I want this position at this price with my risk point today? So that's what I would say is, one main lesson I could remember from Paul Tudor Jones.
I think I'd go back to the systematic approach. To have a suite of indicators or tools, they don't have to be technical indicators necessarily, that you come back to and let those inform your biases, and not to get too bogged down with what we consider to be the noise, right? And the noise can look like headlines. It can be a busy Twitter feed. It can be consuming, too much research. I think a lot of us are guilty of that, even me. I think my inbox is quite full in the mornings. But to really narrow in on the tools that suit your process and your way of thinking, and also your investing style, to know what your investing style is. If you're a trader by nature and you really enjoy sort of staying close to the markets and taking advantage of short-term swings, great. Well, then there's certain tools that will be suitable to that, but those aren't going to be the same tools or the same time frame. Of course, that's suitable for someone who much prefer to, sort of be removed from the market and buy something and hold it for 3 to 5 years, that type of thing. So to know your investment style and to have tools that you come back to repeatedly, to implement that. So, and from a technical perspective, I just think it means having a methodology, and it doesn't have to happen overnight. It's not like, I always tell folks that when they first start reading the books, that's a great exercise because there's so much that they're going to get exposure to, but it takes time to sort of whittle that down into a methodology because you can't be an Elliott wave strategist and a point and figure chartist and a sort of a value oriented investor all at the same time necessarily, right? You have to kind of find your place in the investing world.
I would say to keep it simple. If any investment or financial planning conversation is going to hone in on a theme, it's going to be keep it simple. For me, here I manage $6 billion, but yet I, in my own portfolio, only use a single mutual fund. It's 100% global equities. It's got some factor tilts. Could I do better? Yeah, maybe. But I know that the key to success is just minimizing mistakes and not interrupting compounding. I don't have to check my portfolio. And honestly, I don't take care of myself. We take care of our clients. There's no time to do my own stuff. So that's another piece of it too. But I think all too often people assume that something as complex as financial markets requires a complex solution. And it really doesn't. Life is complex enough. Find ways to simplify, shrink the number of accounts, shrink the number of holdings, simplify your finances, automate as much as possible. Those are all things that you can do to simplify. So whenever in doubt, choose the simpler option.
One of the questions we always thought about after interviewing many of our guests was how they translate their expertise into the management of their own money. So last year, we started a new series called Show Us Your Portfolio, where we brought on a wide variety of guests to find out how they actually went about managing their own portfolio. For those episodes, we also created a revised version of our standard closing question. What is the biggest lesson you have learned managing your personal portfolio that you would teach to other investors? Here's a compilation of all the answers we received.
Oh, just remember the portfolio is secondary to your life. Like that I honestly think we often really lose perspective around that. And I just continually emphasize, it's part of why you hear me railing against the behavior of the Federal Reserve, et cetera. We behave as if everything is about financial outcomes, as if the market tells us truth. There is no truth to be found in financial markets. There is no truth to be found in financial assets. There is no truth to be found in your relative success in terms of your wealth or anything else. The truth is to be found in the smile of your child, the greeting that your wife gives you when you come home, et cetera. Enjoy life and try to be a better person every single day in that context.
There's a quote we've been using lately. Despite all the amount of time we spend talking about the future and forecasting and things people should think about, I think the quote is, for most investors, it's better to be Rip Van Winkle than Nostradamus. Meaning, what does everyone on CNBC do all day? They like predicting what's going to happen with Google earnings or the price of wheat or what the Fed's going to do, and is gold a good part of your portfolio? Like all these things everyone stresses about. But in reality, like coming up with a portfolio, particularly with public markets, like I want that sucker to be on autopilot. I don't ever want to think about my public market investments ever. Like let that thing whir in the background, little robot Meb 2000, and just be done with it. And also, like I see my cash account as like my investment account as a cash account, but it just kind of like hums in the background. And that's why some of these platforms like Betterment, I think are pretty great. Vanguard has one too. But essentially this concept of like, put it in there, invest as much as you can where you're happy and comfortable with it, and let it just happen in the background and forget about it. And spend zero time, particularly in public markets and macro. Going back to, by the way, it's startups. One of the biggest benefits of startups is investing is it's the most optimistic thing in the world. Like you spend all day like, oh my God, these amazing ideas, these life-changing technologies, these impassioned founders. And then you turn on CNBC, it's just like, they're just like bombarded with negativity and wars and pandemics. It's just like barf. Like it's so tough. So to me, spend less time on the like negativity and forecasting and future prediction business, which is impossible, and more on the like, hey, I'm going to save, put it over here. And it doesn't matter what you own. I mean, it does, but it matters more that you save and invest in the first place. This concept, this ownership mentality, I think is important. So be Rip Van Winkle. I like to sleep. I like to take naps.
That one's actually pretty easy. I would just say know what you own, even if it's like delegated through an investment advisor. Like I think it's always a bad idea when the client's just like, oh, you're the investment guy, deal with it. I think fundamentally you have to know what you own, period. And then the second one is do whatever you can to keep the fees and the taxes to a minimum, right? If you just do those two things, know what you actually own and why, I should probably add that, and then keep your fees and taxes to a minimum, it's all good. And as far as investment philosophy, it's also simple. Buy cheap stuff, buy strong stuff, and follow trends. Like, I could do it in one sentence. So investing is frankly pretty simple. It's just people always, they don't follow the basic rules for some reason. It's crazy to me, but in theory, it's easy, right?
doesn't have to be overcomplicated. A lot of times simple is obviously, can be better.
No, exactly. Simple's beautiful. And that's why there is beauty in like Vanguard in the sense that at least people can understand what they know. The fees are very low, the taxes are very low through the ETF wrapper. So it abides by my basic guidance there because they can check those two boxes, which is probably the most important boxes most people should have.
Simpler the better. Honestly, if you can do it with two funds, do it with two funds. I mean, you don't need any more than a balanced index fund and a tax-deferred portfolio. And then in your taxable portfolio, if you're going to have stock in there, total stock market, total international, and something for a reserve fund of some sort. But I mean, the absolute simpler you make it, the better it is for you, the better it is for your family, the cheaper it is, the less taxing it is, and the more time you have to spend doing the things that you enjoy doing, which is not this. I hate to say it, but this is a necessity. I don't know if I could have been an airline pilot, but I decided to do this instead. I'm glad I did it. It was a real good exercise, but at some point in my life, I'm going to not want to have to think about any of this anymore. I don't know when that is. Like I said, I'm in my 70s. I want to rewrite some books and all of that. Maybe it'd be in my 80s. I don't know. But there's got to be more enjoyable things to do than this.
Put first things first, right? We spend all this time talking about money, but money is only as good as the life it builds and the people it serves. And so I think in your pursuit of money, right, in your pursuit of acquisition, make sure that none of it's happening at the expense of the people that you love the most. I think it just becomes really easy to let family and relationships take a back burner when you're trying to get ahead. It's easy to tell yourself that, you'll be around when, or you'll do this when. And, I just think that none of this should come at the expense of your health. None of this should come at the expense of your family. And I think that people who put first things first are going to be all right over time.
Just focus on providing more value in your life than you take, because then the rest just takes care of itself eventually. It's not always a straight line, like you give and then you get, then you give, then you get. But I think, if you just focus on providing people more value than you're taking, I think stuff will work out.
It's the law of compounding. I mean, I think it's so valuable, and I think that people need to stick with that. And in general, just buy and hold, I think, wins out over time. And I think that if you can hedge your portfolio when it's smart, that adds the compounding, right? Because and that could be, I think, a lot of times the edge that people either need or helps them kind of mentally. Because again, it's hard to just sort of say, I'm going to buy and hold through a 20% decline in the market. And so if you can keep your sort of emotions in check, and have like a real plan, it seems corny and hard to do, but once you get that plan down, it does make everything, I think, a lot easier.
It's tough for me. I hate giving advice because I don't listen to any myself, and I don't really think I have any. But I always like to watch what people do, not what they say. And that's why I was happy to be on here to talk about what we do, because that's how I view the world. The one piece of advice I'd give, or I would think about, is that stop thinking about your savings as investments. That's where I think the industry's lied to all of us, is everybody thinks, I'm going to put this money away and I'm going to get rich off of it so then I can retire to a beach somewhere. These are your savings. You need there to be when they need them most and to outpace inflation. As soon as you start thinking about a way to get risk, you're going to take imprudent risks and you're likely going to lose most of them, or they can be underwater for decades. So the only way to get rich is in your business, your job, whatever you want to do, but your savings need to be as robust as possible so they'll be there when you need them most.
That would be the importance of rebalancing. Whenever there is volatility, it's really important to rebalance your portfolio. And I think it's not only doing it, but understanding why you're doing it. So, understanding what's referred to in the industry by some as Shannon's demon is really, really important. And that can be a really critical driver of returns that's much overlooked in this industry.
A couple things. Look at cash flows again. Fundamentals will matter again. That the price of money is going up. And when the price of money goes up, I know that's a weird thing. I think the cost of money goes up. The value of those dollars, cash flows matter more. So, it's not just, that's not just discount rates. That's really, understanding what has real value and what, doesn't, really matters. How far off the ground is that airplane that you're flying, is going to be a real consideration, even though for decades we've been flying very, very comfortably, continent to continent without any, thoughts. That will matter again. And I know I sound like the mumbling man in the corner at this point, because value hasn't meant anything. But I think, at the end of the day, money supply from central banks is the most important thing. And when that is turning, you have to think about what that means for all of your investments going forward.
It would be two things. The first is what I said earlier about investing in the real, and that has different meanings for different people. But for me, at least, it's getting as close as you can to real cash flows from real things made for real people in the real economy. The other is this notion of finding your pack and finding your own identity, and the difficulty you're going to have doing that working for a large corporation. The thing that I've been trying to do for about 15 years now is find a way to stay in our business, right? Financial markets and the like, because it does provide me with the living for funded contentment in the life I want to live, without being in the belly of the beast, without either compromising my autonomy, my authenticity for what I write, but also for not compromising my identity in what I want to say and who I want to be. And that's the biggest advice I've got, is don't compromise on that. Doesn't mean you have to quit your job tomorrow, but find that path so that you're not compromising your own identity and your own authenticity.
I would say just know that over time, your portfolio and your investment philosophy is going to evolve. So maybe don't, cling too tightly to your current investment beliefs, but at the same time, you also, to kind of borrow a quote that I heard, I think originally from Cliff asking this when he was on Corey's podcast, was, keep an open mind, but not so open that your brain falls out. And I think it kind of ties together with this idea of holding your strong beliefs loosely. So, you don't always want to be turning over your portfolio or changing your stripes based on the whims of the market and what's happening in the near term and whatever noise is out there. But at the same time, don't be so rigid in your thinking that you can't be open-minded to evolving over time. So that's probably the one thing I've learned from my own experience that's, I think, been helpful, and that I would try to, impart to anyone who'd be listening.
Who am I to give anyone advice? It's such a personal thing. I would say, here's something I feel very confident about. Think holistically, right? When you think about your investment portfolio, do not forget to consider your human capital. Do not forget to consider the things you want to do with your money. Those are, we'll call them liabilities, but the things you want to spend money on, and figure out how that all matches up. Because again, I think ignoring that human capital element ignores a huge, important investment in your life. And I think if you consider it as an investment, it makes the whole picture a lot clearer.
Don't chase performance. It's endemic. It's innate in the human psyche. The notion of something's hurt me, get me out of here. Something's been good for me, given me profit, given me great joy. I want more of that. This is all very much human nature. It's a horrible way to invest. The notion of buying when you're at peak fear goes totally against human nature. It's a great rule of thumb. And a lot of it all
is just different manifestations of don't chase performance. Even the quant community chases performance. Put together a bunch of factors in a multi-factor portfolio based on using the factors that have the best historical track record. Well, it doesn't mean they will have a good future track record. And so it's a backdoor form of performance chasing in a group that thinks they don't chase performance.
Deeply informed simplicity in whatever way that means to you. If you can start eliminating, not adding pages to a playbook. Most folks, the more they save, the more successful they get, the more stuff they end up owning. And keep it simple as that. And I'm sorry to go out of order. That's just how I like to do things. We turn things upside down. That simple pie chart, I really do keep it that simple. And then sell disciplines of it under everything. That would be it for me. That's what I've learned and has made my career.
I would say, risk happens really quickly. And so, when you get yourself into a bad situation, what people tend to do is they start risk managing their P&L. They start looking for, ways to get out of positions, levels to get out of positions. And they start playing doctor. They're sort of in triage, right? And the reality is usually when you're in those moments, that's usually the market giving you new information about the evolving distribution of probable economic and policy outcomes. And so in that moment, your focus should not be in playing triage in your current holdings, but more importantly, trying to understand, holy shit, something must be changing really quickly and really meaningfully from a macro and policy catalyst perspective, that I need to really focus a lot of my attention on that. And once you do that, then you can go back to playing triage or whatever version of triage you need to play based on that new information. To me, I see it all the time. Like even I feel it as a human being, when I have a bad run. I had a crappy job. We were having a phenomenal year, up double digits, I think, in mid-June. And now we're up low single digits, right? They had a significant drawdown in July. The market went straight up and we were called net short throughout that month. And the entire time I was constantly having to fight myself from just playing triage and stopping myself out. And what I really focused myself on, spent a lot of extra time just trying to understand, okay, what's driving this? How sustainable is this? And ultimately, there were some very positive fundamental drivers. We don't have to go into that in this particular podcast, but there were some very positive fundamental drivers. And so at the end of the day, as a portfolio construction, from the perspective of the portfolio construction, you did have to make a few minor changes. We're still leaning that short, the market, but we had to make some adjustments based on the specific factors we were long, because the probability of outcome ABC, we don't have to get into the details, actually rose. And so to me, that's a great example of, okay, let's just not play triage. Let's actually do the work in understanding why we need to play triage in the first place, because in those moments, usually you're getting some very significant, meaningful changes in kind of the macro drivers.
That wraps up the Show Us Your Portfolio answers, but we still have a lot more insights from our guests left. Here are the rest of our excess returns guests returning to our original question: if you could teach one lesson to the average investor, what would it be?
Well, the one thing that I would highlight to people, and it's a phrase that I use all the time, is why are you reading this now? Right? It's a variant of Ben Hunt's narrative dynamics, right? Which is, why are you suddenly being treated to this information today? Because it's not being, the news is not being sold to you for your benefit. It's being sold to you for the benefit of somebody else, right? Whether it's to sell advertising dollars, whether it's to place propaganda, whether it's to engender loyalty to a particular news organization, etc. Why are you receiving this information now? And I would, by and large, highlight that a lot of the information that we're receiving right now is designed to effectively cause people to go into a frantic type of behavior where they're saying, oh my God, abortion rights are going away, or oh my God, all the kids are going to die, or oh my God, I have to do what my party, what my tribal affiliation tells me I have to do. The more effective you are at removing the emotional component and the panic that is associated with the narrative that is being thrown at you, right? Ben Hunt very successfully uses things like Bitcoin and, exclamation points, right? The more effective you are at saying, why am I being told this? Why am I being sold this piece of information? The better you're going to be at critically evaluating that information that's presented to you. And I would just encourage people
that much of the information that we're being provided with today is designed to engender a response. It's designed to engender tribal loyalty. You have to do this, otherwise you can't be part of the tribe, because clearly people who don't do this are part of another tribe. We're all members of the human race. We're all here to benefit in a collective sense as well, at the same time that we're trying to succeed on an individual sense. And so just try to take a little bit of a deep breath and look at what's going on around you and be maybe more calm in the assessment of what your response should be.
I guess the first thing that comes to mind is there is no universal playbook for investing. If there was, everyone would be following the same thing. So there's no 1 or 10 right ways to invest. And there's probably a lot of wrong ways to invest. But there's also a lot of reasonable ways to invest. And the most important thing, in my opinion, is getting to the place where you're comfortable doing what works for you. Even if that's, something that would be subpar in a spreadsheet, 40% cash, 60% equities, whatever it is, whatever you have to do to get to the place that you can stick to the strategy through thick and thin. And when I say stick to the strategy doesn't have to be buy and hold, but you have to have some sort of philosophy that governs you, right? And because if you don't have that, then you're just flopping like a fish out of water. So some people get there quicker than others. Some people never get there. But I think that would be the most important thing, is just to find whatever jives with your personality is the most important thing.
There is a very easy way to do okay in the stock market, right? And that is buy an index. And odds are, you will do very well over your lifetime. Picking stocks is very hard. It's incredibly competitive. And so if you're interested in it, you just got to think about, how much do you love it? Right. And you also have to think about your temperament, because with any strategy, there's going to be times like 2008 where it goes down, 37% or so. And, for some people, it's just, I think, better to lock it away and not have to think about it every day. But for others, if you're passionate, and you feel like, you don't worry too much about the daily ups and downs, then, it can be a really exhilarating thing.
When it comes to long-term investment success, character is more important than IQ. Character meaning sticking to your philosophy and not giving up at the wrong moment, giving up on value, when value didn't go well and you miss out the rally. So character is more important than IQ for long-term success. As having strong hands and stay committed to a strategy is not easy. One famous academic study, which is not famous, a study I like a lot, which is maybe not famous enough, is dealing with this about the difference between investor and investment returns. There's a big gap between that. That's 2% alpha on average, and it's increased over time. And that's purely due to adverse market and adverse style timing of investors. So they go in and out at the wrong moments. We all know the anecdotes of this, but there's a great study by Dietschef in the American Economic Review lays this down and gives it a number 2%. And that's a lot of alpha. If you just have your staying power, I call it strong hands, where you stay committed in your, for example, quant strategy, but it can be any strategy. If you thought about it, execute right. And to do that, you need more, it's more a test of character than of intellectual quote. So that would be my important lesson, going from PhD and academics into practice, and also translating academic factors into real money for clients.
I've learned a lot of lessons in the last couple of decades, but I think one that I would say is turn off the, don't listen to what the institutions say, don't read their research reports, find some systematic rules-based strategies that are complementary to each other, put them in a portfolio, and then go live your life and don't worry about it. But don't get caught up in what the news is, because the news gets you to do the wrong thing at the wrong time. almost all the time. So I would say you would be doing yourself a favor and your portfolio a favor by turning off the news, CNBC, Bloomberg, Fox Business, and don't read the institution's research reports. Find some systematic strategies and you'll be.
I'm working on this for a book, so you got that scoop first out of me, which is good. And it's, I'm trying to tell my kids and young investors, but the cool part is my 90, and we've now got 5 clients over 100, they would probably say the same thing. They're still playing the long game. If you avoid an increasing supply of shortcuts, which are in front of us every day, you're all of a sudden, no matter what you're doing, investing included, with the most easy and tangible to see results, you're already finding yourself on some pretty uncrowded paths if you look for every long cut imaginable, and that's not easy. Instant gratification's a real deal. Deferred gratification isn't very popular. I don't even think it's a term, but if I have the choice and the ability to play the long game, I think what I've realized that I come to appreciate more with every passing day since I left Wall Street and started an RIA is this world of abundance where capitalism works because of competition, and it's wonderful. It's the most pure, longest lasting system I know of. But to be a happy human being, live in a world of abundance. And it is a small, beautiful world, and how you treat people is a big part of this too. And I know I'm getting a little off the path of an investor-only question, but I think they collide with each other. So playing the long game, not just with your investments. And I think, and I said it earlier, it's easy to say hang in there and play the long game. And by the way, notice I didn't say hang in there. I think anybody should fire their advisor or portfolio manager if they're ever told to hang in there. I think there has to be some sell discipline in life if you're willing to play the long game. You got to stop doing things that are not working and do more things that are working.
I'd say to be flexible and also to enjoy life for sure. So I do, and kind of this whole 4% rule debate, I do tend to get associated with 4% is high, and therefore you've got to be more conservative about your approach to retirement. But being flexible, being able to go with the flow. I mean, people at the end of the day might be okay if they don't have much more than a Social Security benefit. And it just makes sure you're not overly saving or not accounting for the fact that spending may decline with age. And so to strike the right balance between enjoying the present, but also being responsible about protecting the future as well, and to not get too carried away in either direction.
It would be to be confident, but don't be so confident where you can't pivot. I mean, some of the places I worked at in the past, the most brilliant traders, they could be long an idea and the facts change, and they can be short an idea. I mean, that type of flexible thinking is very impressive. To not be so wedded to a situation. I think when emotions get involved and you get so deeply rooted in a position, that's usually when you start to make mistakes.
Stay the course in the stock market for the long term in a portfolio of good quality stocks for resilient wealth creation.
Back before I went into investing, when all I knew was physics and science, was I an average investor? I was probably a below average investor back then. And my advice to me in those periods would have been, simply be invested. And I think that's a very, very important point. It's, for your average investor, being invested, sticking with it is very, very important. For the average investor who knew would have known more than I did as a physics major when all I knew was physics, I would say, make your plan, stick with it, know that you can take what's coming, diversify and diversify across different sources of risk, across different factors, and, keep your costs low, but make sure that you're getting, what you paid for. And in this case, I would say that, keeping your costs low doesn't mean necessarily taking the cheapest fund, but a fund or a strategy that gets you a good amount of exposure to those factors that matter for the cost that you're paying. That's my 2 cents as a long-term factor investor. I guess where I come from.
Be humble and be patient. That's cheating already. There are some two things there, and like so that points to diversification, strategic thinking, and trying to be more systematic, humble and patient.
Have a framework, ideally a robust framework. I think this is where it all starts when it comes to investing. If you have a robust framework, knowing kind of what you can say about markets and what you cannot say about markets, will inform you how you go about investing. Do you go with managers or strategies that try to kind of outguess markets? Do you not go with that? Do you go with just an index solution? Have a framework for what you need to do if it's a long-term investment or a short-term investment. What type of asset allocation will work best? A framework will give you the best foundation for a good investment experience.
I would say be part goldfish and part elephant. So goldfish have an incredibly short memory. Elephants have an incredibly long memory. Researchers have shown that elephants can actually recognize enemies and friends over a long time frame. So when the market falls by 4% on a single day, be like a goldfish, kind of look past it and just forget it, because typically what we found, and again, the stat could be off by 1 or 2 days, but when the market has its 10 worst days, it's typically followed by its 10 best days. Then sort of be like an elephant. Understand that over a long time frame, there's certain premiums in the market that's been rewarded. Diversification has a long history of being beneficial to overall portfolios. So definitely take that long view, have that long memory of what has historically worked. So I always sort of think about it, be part goldfish, be part elephant.
Know what you know and know what you don't know. And if you, make your money doing some kind of certain function or specialty in the world, go and do that. Unlikely that you're a professional stock picker that could pick single name stocks. The time you've heard about the story of any stock by the taxi driver, the story's probably already over. So, be diversified in what you do. Doesn't mean that you're index per se, but be diversified in what you do and don't place all your eggs in a single basket. And then finally, try to control your ego, which is against your nature, but try to control that. It was very hard to, especially when you're in a group of people, to go and, not everyone with all of them. Be careful about that.
Steve Cohen, talking about trading losses. I said, about how do you get out? I said, well, what do you do when there's a position you have on and you just undecided, you're not sure if it's just a short-term move against you or you're wrong. And he says if he's ever in a situation where he's not sure, first thing he does is cut it in half. And if he's still unsure a little while later, he cuts it in half again. He says, you know what? Before too long, you don't have a problem anymore. And it's a great piece of advice, really a stupendous piece of advice, in my opinion, because a lot of people become frozen. They can't decide, hey, I get out here, I'm going to sell right at the bottom, and then the market's going to reverse. Or I hold on, it's just going to keep on going. And they think like there's just a choice of holding everything or selling everything. And they have a problem realizing that you have a continuum of choices. You can hold anything between 0 and 100%. You don't have to have a 0 and 100. And the decision between 0 and 100 is very difficult. But so one thing to that piece of advice where you're uncertain, get out of something. Just get out of something and then reevaluate it. So that's a good general principle is not to do everything at one time. And that works for scaling into positions, scaling out of positions when you're undecided. It's breaking trades into components as opposed to just doing everything 100% one way or the other. That's a really critical piece of advice.
I wish it was a really simple thing. I think it's a simple idea, but it requires more work than I would love. But that is, whenever you're investing in something, make sure you understand why you should get paid for owning this asset, for performing this activity. Understand why it not only makes sense for you as the investor, but whoever is going to be funding that investment on the other side. Why it makes sense for them to be giving you the return you need. I would say there's a lot of errors people can make as investors, but one of the crucial ones that people make time and time again is forgetting about the fact that if you're going to sustainably get a return, it needs to make sense to give you that return in terms of the person on the other side. And where you can't answer that question well, you're not investing, you're speculating. So I would say, for the retail investors who are buying, 1 week call options on AMC, the reality is you're not investing. The person on the other side has no reason to want to give you a high return, right? The person on the other side, for one thing, is a market maker, and the market maker is the casino. The casino is only there to try to make money off of your activity. But the simple truth is, whenever you're buying a call option, you're not doing anything useful. You only get the upside. And if you only get the upside, the person on the other side only gets the downside. There's no reason for them to want to give you a good return in the long run. So I think investors could avoid a lot of errors if they thought not just about, does this make sense for me? But does this make sense for me and the guy on the other side? If it doesn't make sense for the guy on the other side, this is not going to be a sustainable strategy in the long run.
Well, there's so many I could say. I did tweet a quote from Soros today, and it's one that I have believed in for many, many years, and that is, don't be skeptical. Don't be skeptical. Buy the breakout and look and get in gear with the trend, and don't be afraid to add markets that don't make sense. I mean, I was so negative on the iPhone when it first came out. This is not going to be anything. And how dumb is that? You should have this attitude of a child and believe that it could be something. You never know. It really is just a twist on, you're going to have a bunch of outlier trades that could make you 1,000 or 5,000%, and then everything else will be pretty much a break even or a loss. But just, attack your investments and your life in that particular way, that you want to be on board with crazy things that probably won't happen, but every now and then Bitcoin comes along, Apple comes along, and the great things about life, the technology comes along, and just embrace it, make a small bet on it, and follow the trend, and don't be too hesitant to get out of that trend and hold on. But don't overanalyze. Even the best people cannot predict what's going to happen in these markets, and the best way to attack the markets is through a systematic rules-based approach that basically says, I have no idea, I'm just going with the trend.
Patience. And I know that's the overused word in the value investing. I don't know why it is that we think we have to make constant decisions every hour, every day, every week, every month, every quarter. The markets are not going to pass you by. Wealth is not going to pass you by. If you're patient in making your decision, and the decision has been made by all of its constructs, when all that comes together and it's time to pull the trigger on an investment, you never look over your shoulder wondering, had you made the right decision or the wrong decision? Because if you have that little bit of doubt, self-doubt, you're never comfortable with the position. You end up selling too soon, and you're not able to compound it over time. Warren has made tremendous amounts of wealth by patiently investing in good opportunity. This rush to make as much money as fast as possible in the shortest period of time, I'm not sure that that's the right recipe for compounding wealth over time. So patient decision making. Just take your time. It'll all work out.
I would say it's to know where the return is coming from. I'm a big believer in investing in multiple sources of return, whether it's factor return, equity risk premium, the vol risk premium. But I think when you look at your portfolio, when I think of my portfolio, the one I'm relying on for my retirement, I want to know that the return is coming from systematic sources. It's not totally skill-based. Anytime you're relying on skill to outperform, I think that's a tough bogey. And if you look at successful investors from Warren Buffett on downwards, they've had a lot of systematic trends that help them, whether it's value, whether it's leverage, whether it's quality. And I think knowing that you have these systematic risk premia driving your investment is really, really important.
The mistake 99% of investors make with some regularity is buy high and sell low. Whatever is newly expensive got there by creating great joy and profit. People don't want to sell. Whatever's newly cheap got there by inflicting pain and losses. People don't want to buy. But if you can impose on yourself a discipline of rebalancing, a discipline of saying, this asset has been so successful, it's been wonderful. Is it out of line with the underlying fundamentals? Should I cut back? For growth strategies, always have an exit strategy. If you don't have an exit strategy, you're going to ride the full cycle and you're going to get hurt. For value strategies, always have an entrance rule, a reason to buy. And our entrance rule is very simple. If something is cheap relative to its fundamentals and it's no longer in free fall, it's okay to start buying. And you nibble away, and that way you wind up with peak exposure of the trough.
You guys asked me this in advance, and I tried to cycle through like 100 different ways to answer it. All I'll say is that investing, it's like any professional discipline. Whether you're a professional athlete or a professional poker player or a professional utility repairman, there's 100 different things that you happen to be doing correctly. When you've achieved, call it the top echelon, within your professionalism, and investing is no different. I've been investing now for almost 18 years. And there's mistakes that I made in the first 7 years that are very difficult to think back upon. But each one of them built little sort of muscles and awareness and tools, that I've been carrying with me. And so I think it helps you stay humble as an investor to look back and know how many mistakes you've made. You're going to keep making an enormous amount of mistakes in the future. And so the only thing that you can control is every single time you make a mistake or a bigger mistake, what is the thing that you've learned? You need to take the time to reflect on what you need to learn from that or something you need to change in your process to at least remove the potential of that mistake to come back again, because you're going to make a new one coming up. So that's what I would recommend from a process development standpoint.
Try and check your portfolio less frequently. This is really hard for professional investors to do for obvious reasons. Provide private investors, it is certainly possible. So I think if you want to control your behavior, one of the crucial ways of doing it is to interact with your portfolio less frequently. So make sensible long-term investment decisions and stick with them. It's a key motto, I think, for most investors. Doesn't mean you never touch them, but if you're prudent and moderate in how you interact with your investments, then you're far more likely to make good decisions and fewer decisions through time. If you interact with it too frequently, you're increasing the risk of making behavioural mistakes, which will just compound significantly and negatively through time. So check your portfolio less frequently after making sensible decisions at the start.
I think the one lesson I'd impart to investors or people is, I think the phrase, this time is completely different, has been overused in the market. I think I've heard that so many times, and I'm not saying things aren't different in some ways, but I think the idea that things are completely different is often not true. I think that if you look back in history, you can often find parallels or a combination of events that will probably help you explain what's actually happening today. We've just been through COVID. Is global pandemic unique? No, but there's been some unique aspects to it, and you absolutely can learn bits from history. So I'd say that with proper research and proper looking back through history and proper understanding of how markets have reacted and how humans actually react to events, you can actually find decent insights into events that you're trying to understand at the moment. Don't immediately assume that this time is completely different and you can't learn something from history.
I think it's just, keep your mind open to new things. There are constantly things being learned and previous relationships that no longer hold up as well. A good example would be just, now that bonds are in an uptrend after 30 years of a downtrend, like the world looks completely different and you have to just really reassess prior relationships. So, I've looked at market structure over time, the way that's changed, the way things trade. So, the one thing about this world, it is not stagnant. And so, learn a lot, but then keep updating your knowledge.
I would say try never to sell.
We had a lot of fun with sell discipline earlier. I think too much is made of it. I think you have to think about selling a lot if you're not buying good stuff in the first place. Like maybe you were buying it for a trade. You thought maybe we're in a cycle and you'll sell at the end of the cycle. You're trying to time the market. And so many reasons that people sell are because the thing they bought in the first place, they didn't buy something excellent or they didn't buy something that would persist. But those are the two things that I'm always trying to do, is I'm trying to buy things that are excellent as early as possible, and I'm going to let that persist for better and for worse. And so I really don't have to think about selling too much. So the less you think about selling, the more you're thinking about the quality of what you're buying. Buffett has a great line, I'm paraphrasing here, something like, imagine if you had a ticket you could only punch 20 times in your life, and they're the 20 buys you can make, and you can never sell. And if you take something like that as your mentality, I believe that you will do better with all of your investing than if you didn't. So I love the wisdom of don't sell, try never to sell. That's been what I've demonstrated. Like all of the stocks that I'm hyping myself up with because I picked Amazon at $3.21 in 1997. These stocks, we still hold these stocks. And that's such an important lesson. Maybe the reason I ended with it is because that's the most important lesson I can think of for your listeners.
Sit on your hands. It's underrated, this investor behavior thing, but the hardest thing for people to do is nothing. It is by far the hardest thing to do. It's also really hard for people like us that are in the industry. I think our investors expect us to, buy something, sell something, do something, move something around. But more often than not, doing nothing is the best advice. Build a solid, well thought out strategy. Sure, keep an eye on it, make some adjustments here and there, but basically holding things for long periods of time is usually a good recipe. And the only other thing I would say is save more. So buy things and hold them for long periods of time and save more.
Buy and hold. The miracle of compounding is very, very, very important. And it's not something I've been great personally in sticking with throughout my entire life, but I think that's the most important thing.
I'm going to approach this with the most important decision that they're going to make, which is asset allocation. Understand that economic environments change. Here are four major categories: high inflation, high growth, low growth. Build a stable asset allocation mix that could handle each of those economic regimes and stick to it. Don't be too tactical. Don't completely move in and out of asset classes. It's fine to adjust at the margin, but don't be too aggressive with that, because we're talking about increasing the amount of time you have to work and what you could do with that money eventually, right? By making careless errors. And I've seen too many people over time be too aggressive with tactical shifts. So stay strategic, ride through volatility storms when they happen, and look at them more as opportunities as actually opposed to running for the doors and selling everything.
So, if I think back to my experience, I started investing in high school. My golf coach actually got me into investing because we would ride to these golf matches, and this was in the late 90s. So he was on the phone with his broker selling call options on Cisco, which ended up not working out in the end. So that was a good learning experience in and of itself. But it took me a long time to figure out is that everybody spends time on what we refer to as security selection, what to buy, which stock to buy. And the sort of gap between, I think, most average investors and most pros is it's really twofold. So that the two other aspects of investing that there are very few, I should say, one of them, there are very few books about. The other one, there are lots of books about, but they're very sophisticated and they're geared towards institutional investors. So the second aspect that I think average investors need to understand and learn is portfolio construction. So you got to figure out how to size positions appropriately, because I think what a lot of people sort of do, and what I've seen is people will get super excited about an investment. They'll do a ton of work on it. But it's, one addition to their existing portfolio of 10 other names. But because they're so excited about it, they always size it the highest, and they usually oversize it. They never want to sell it if there's if it goes into a loss position. So there are all these psychological issues. So learning how to size positions and manage them, I think is unbelievably important, but there's so little information that exists about how to do that. You really have to dig. And then the third component, so security selection, portfolio construction, and the third one is risk management, which again, there are tons of books on it, but they're not really approachable. It's really all about how to sort of bank your winners and cut your losers really, really quickly. There's actually one book that actually just came to mind. The Zurich Axioms is a really great one that speaks to sort of risk management, not sort of explicitly, but that's effectively what the rules are. And it's kind of like, from a golf perspective, security selection is like that guy that always goes to the driving range and he's always just hitting his driver. Portfolio construction is like the guy that's around like the chipping green, constantly working on his short game. And risk management is like the pro that's on the putting green, just banging out 8 and 10 footers, 100 of them before going on the course. And I think that a lot of people kind of miss the second two elements. So it's kind of like studying yourself. Keep a trade journal or an investment journal or whatever your preferred style is to invest, and sort of measure your win rate, your average wins and losses, things like that, to kind of, view yourself in the mirror. I think all of those things will make a lot of people much better investors. I mean, we do it. We do it as a team. We do it all the time. We do it on our strategies, our factors, our themes, everything.
I heard this from someone describing a philosophy of life, in terms of their life's journey. And that would be investigate carefully, choose wisely, and follow faithfully. So I'd say the same thing applies to investing. Do your homework, do as much research as you can to satisfy yourself that what you have makes sense, that it's something that you can stick with and not lose confidence in. Go with it. Don't be shy. I come across people all the time who say, well, I just want to stick my toe in the water, see how it does for 6 months. And that's not the right attitude. Anything could happen, 6 months or a year, 2 years, whatever. What you need to do is do your homework, do the research. Be sure that what you have makes a lot of sense, then commit to it, and then stick with it until you have some good reason for changing.
I grew up under the great Warren professor, and we're actually in the process of doing the 6th edition of Stocks for Long Run, which I'll be joining as co-author this time. And so I think if I have one word to wisdom, it's stocks for long run. Now the question is on other things, and that's a lot of diversified stocks for long run. So buying index funds, buying broadly diversified baskets is one of those, you have a core allocation, call it 80-90% of your assets in a core long-term strategy, but you might have 5-10% in things that you think have these bigger growth opportunities. It gives you to have more trying to quote unquote beat your core allocation, or things that you're more speculative, you might say, or things you enjoy trying to find, or have that separated account from your core allocations, I think is something to be thinking about as well.
Keep an open mind, and as a technician, wait for price confirmation. One of the biggest things that I personally have had to overcome, and I see a lot of younger technicians or traders, is they get a thesis, they get a reason that something's going to happen in the market, and the timing is going to be the hardest part of that. And so if you're really expecting a large change in price of a security, of a market, of the VIX, letting it begin to confirm your thesis before you really try to take advantage of it. There's many people that have been in finance who've been calling for a bear market. They've been calling for a crash for 10 years. If they just waited for price to begin to confirm that thesis, they wouldn't have had pie on their face this entire time. And so I think by having an open mind to different possibilities, and if you have a thesis, let price begin to confirm it and say, okay, I think the stock is going to bottom. Does it start to move higher? And so with some of the bottom trying to dumpster dive that I'll do for trying to bottom tick a stock is let it start to rise. I don't need to buy it on that very bottom day. Let buyers start to come in before me and then start to ride that potential change in momentum higher. So I think looking for price confirmation and keeping an open mind that maybe you're not right this very moment, I think can save a lot of people a lot of pain. It was an important lesson I've learned through my time as a portfolio manager and technical technician.
So
I'm going to kind of give you an answer that's a little bit more financial planning than investing, right? But as I think about, and I've got daughters who are now in their early 20s, so they're starting to think about this. That's maybe why it's top of mind. But if you want to grow wealth over time, then a couple of things are important: time, taxes, and rate of return. So take the gimmies, right? And the government gives you tax-free compounding, and you can start as soon as you start making a buck. So take those easy wins and set yourself up for that long-term success by doing that. And, max out your 401k or your 403b, max out your IRAs, protect as much money as you can from the tax man for as long as you can, right? You can't get you can't get 2021's investment opportunity back in 2022. You got to seize it then. So spend less than you make, free up that cash to invest for the long term, and set yourself up for success that way. Those are easy wins. Don't take a lot of thought. Excuse me. And frankly, for about 10 years of your investing life from the time you're 20, that's about all you need to know. You'll be fine. You'll be good. You'll be way ahead of most people, frankly.
Everything can be analyzed. And when I meet, people are often looking and going, but I just don't have the time to analyze that piece. I don't have the skill set or the know-how to come to an answer. But use your own framework, use your own judgment. And that framework may be for analyzation. You may just say the stock price might be $50 or it might be $40, but I'm going to put a 60% chance on it's going to be higher, and I'm going to put a 40% chance it's going to be lower, and I have an expected value. That would be a simplistic model. Obviously, you can take that to the nth degree, but have your own framework, whether it's in your head or on paper or in Excel. Trust your gut and do so before your fear impulse takes over. Historically, your fear impulse starts taking over after about 5 seconds. So once you come down to a gut feeling, a gut decision, you need to stick with it. And that's kind of the hardest part. And that goes for not just investing. That's life of wake up, give yourself 5 seconds. I believe in that paradigm of your fear decision takes over. You start weighing downsides and other things. What is it going to look like if I invest in this company, or what happens if this one goes bad? Obviously we are risk controlled. We have analysis on everything we do, but in the end, it's trust our gut and go with a decision and keep going.
Yeah. And I touched on this earlier, but it's a point that I cannot state enough. Munger's principle of ignorance avoidance. Okay. You're trying to eliminate negatives in your investing life. Okay. And I say that because I mentioned our 8 criteria that we use for stock picking. If someone says, Cole, are you trying to find things that fit? No, we're trying to prove things don't. And if we can't prove it, then we might be onto something. It's that negative art aspect that I think is the most important. It's like Buffett used to talk about. He said, rule number 1, don't lose money. Rule number 2, refer back to rule number 1. He doesn't talk about that as much anymore because I think as his returns have demurred, I think he's very much, been a lot more humble about that. And I tip my cap to him for that. But again, the idea of not doing stupid things. What was 2022? Who was doing stupid things? And that's who's being rewarded or not based on that idea.
So I think we touched on some of the things. So don't use accounting information without first evaluating the quality of the information. Also, consider accounting and other measurement issues, and we touched on this, whenever you define or use factors. So that's another thing. And now to my business, tech accounting classes, maybe even executive education programs. I run several programs at Columbia, and they're doing very well. I run a program where I have a lot of, CFOs, portfolio managers. The last iteration, I had 56 participants, so people find it quite. But I go into these earnings quality topics. And then I'm still talking about what I do. My earnings quality monograph, which is a very, very comprehensive document, and I'm still work in process. But that's basically what I want to leave as my legacy in this business, which is basically have a very comprehensive analysis and one source for earnings quality.
So I think this really came from a number of the luminaries. And the key piece of advice is to really understand that we all have simply just 4 levers that are available. The first one is the target size of your financial goals. So we can think big or we can think medium size, but it all starts with what those financial goals are. So we can adjust that as well, but we have to use that as a starting point. That's a lever that we have. What kind of lifestyle we want to have in retirement? Do we want to own a cottage or not? These types of things. Secondly is how much do you have and how much are you willing to contribute regularly to your savings and investing? This doesn't happen magically. Back to this whole notion of discipline. There are strategies of paying yourself first and making that investment be at 10% of whatever your income might be. But really thinking hard about how much you're willing to contribute to your savings. And again, that's up to you, whether it's 2%, whether it's 10%, whether it's 15%. The third is the length of time you have to achieving your goals. We might all want it by tomorrow. We might all want to retire by age 50, and realistically, that might not happen. So that time until you achieve these goals is really going to be up to you. And obviously, the longer that it is, then the more achievable it is. And the final one is the expected return you're going to get on your savings. If you are going to put 100% of your investments in treasury bills, you're going to have a much lower expected return than if you put 100% of your investments in equities. And so if we think of the first three of those elements, the size of your financial goals, the willingness for you to invest on a regular basis, and the length of time that you have, once we take those three into account, then the expected return should fall out of that. And that expected return will then determine what your perfect portfolio is. Is it more heavily weighted to equities, or is it more heavily weighted to safer assets? So if you think in terms of those four levers, and really those are all the levers that we have, that should help you to determine what your own perfect portfolio is going to look like.
Work on your kids and get them interested in a disciplined strategy when they're younger, so that when they become a millennial like I was and like you have going on right now, they have a second perspective to what's going on in investing. So it's not a black and white thing. I think what happens is the way we were, it was color TV stocks, it was Pan Am, it was all the hot stocks of that era, all the growth stocks, and we didn't want to invest in anything else. That was all we wanted to invest in, but I think it's good to have some balance. So I think people should try to educate their children and what have you, to have a little balance in the whole investment program. You can still trade if you want to, but make sure you have some balance.
For me, it's that investing is perpetual. Like, there's always this thought with retirees that, like, I should be in cash or I should be more conservative. And I'm always thinking, especially with folks that accumulate assets above a certain threshold, which we're very fortunate to work with folks who have been typically successful, the money's going to outlive you. And so, like, your time horizon is relevant to the extent that you can make decisions. But if you're investing for your kids, or like I said, you have charitable intentions, a charity doesn't die. Like, the Ford Foundation is going to be around forever. The Tuxedo Park Library is here indefinitely. And I think that to me lends itself to taking on more risk. And so I, like, in my personal investing, because I kind of think this way, I'm opening Roth IRAs for my kids. I plan on my assets lasting for 150 years, something like that. Education, to me, is the key priority for me and my family on what I'm saving for. And so I think just thinking in perpetuities is probably the right mentality to have, and not to sort of think only about what happens this year, this month, this day.
Yeah, actually, the first thing I think of, because I mentioned it before, is don't swing at every pitch. Just wait for the right, but also because you guys are value investing, so let's go here. He had this bias that it was interesting. He developed this methodology, and it kind of put the markets based on a value approach into tells from the most attractive to the least attractive. And told me how effective it was, that it actually, that when he tried it, that they came out in exactly the same decile order or whatever. I said, well, let me ask you a question. I said, I understand why you invest in the top decile. Well, wouldn't it be better to invest in the top decile and sell the lowest decile and then have a, balanced, a neutral market neutral portfolio? Then you get even better return risk, would you? And he said, it's a great idea, except you would go broke. You would have gone broke doing that. And his point was that there are years where it's exactly reverse. Your lowest decile, like 99, your lowest decile does extremely well, and your top decile does. So it's not like they hedge each other. It's like you've actually have a leverage bet, and you can get wiped out where normally you wouldn't. So that, but he said in value investing, he said, get this right. He said there's three things about value investing. Also, get this right. He said value investing works. That's rule number one. Rule number two is value investing doesn't work all the time. Mm-hmm. And rule number two is while rule number one works.
Right.
Well, that's what I remember.
For the average investor, I think in terms of advice, we both exaggerate for the efficacy of these models and also exaggerate the risk. So we've got two types of people. One is advice of, telling everyone to lean towards value and momentum and those sorts of things. Because the history tells us that. And the other is basically saying, you guys are uninformed investors, just buy the market and do nothing else. I think in some sense, both sides exaggerate. I think that I don't think it's too risky for retail investors to tilt a little bit towards these factors and to, be a little bit active if that's what they like doing. The cost to doing that, I don't think is particularly large now. The markets are pretty liquid and you can trade without commissions. So as long as you don't do things completely crazy, I don't think you're going to lose your shirt on that. As long as these guys understand that, the first thing they need to think about is having a portfolio that's pretty well diversified. But on the other hand, these markets are pretty efficient. People like me were mainly in the business of doing history rather than predicting the future. And so I would argue that I've looked at these markets and I think we've pretty thoroughly rejected sort of the formal view of market efficiency. If you look back in the 60s, 70s, 80s, 90s, I think the evidence is that the markets after 2000, at least in the United States, look reasonably efficient. So I would suggest that retail investors, go into this thinking that they can, in some sense, beat the market.
I use trading or investing to practice excellence. So Aristotle says excellence is never an accident. It's always the result of high intention, sincere effort, and intelligent execution. And it represents a wise choice of many alternatives. Choice, not chance, determines your destiny. If you cannot be patient with your trades and your thesis, how can you be patient with your children? Or if you cannot be humble about your theses, how can you be humble with your friends or your wife? If you cannot be disciplined in your trade plans, how do you be disciplined in anything else in life? When you're trading, there are no lies. There's no participation trophies. There's no moral victories. It's just price. And price lets you know exactly where you stand at all times. And you must exercise virtue to succeed. So my overall advice is let the markets make you a better person as opposed to dictating your life.
I would say two things. So before I get to the average investor, I'll just mention the average investment professional, folks in our industry. And I mentioned this at the top, and I think it's around, be humble. Like, don't believe your own cooking, I think is another way to say it. So often someone runs a back test and it's amazing and they don't really understand what it's doing. But like, look, it worked. Of course it's great. Of course it's going to work. My normal question for when I see something like that is, well, if something is so good, why isn't everyone else already doing it? Like, what have you found? I always think it's an interesting thought experiment to say, think about the distribution of people in the U.S. and try to place yourself from an intelligence perspective on that distribution. I don't know what the right answer is, but let's just say you think you're in the 90th percentile and there's, 320 million people in the U.S. That means there's 30 million people that are smarter than you. Now, they're not all doing what we're doing, so fine, but ask yourself just questions like that. I think it just helps kind of put things in context and helps us to ground ourselves a little bit. As far as the average investor goes, I was a big X-Files fan back in the day, and so the idea of trust no one is still always resonates with me, and that as an average investor, we have to put our trust. Just like when I take my car to the mechanic, I have to put trust in that person that they're, telling me the right thing for my car, since I know nothing about how, what happens under the hood of a car. You need to put some trust into to the folks that you're working with, or maybe trust but verify is a better way to say it. But ask questions. Don't just assume that someone's telling you something and they always have your best interest in mind, because maybe they do, maybe they don't, or maybe they're maybe they're just not putting in all the extra work that they need to. This is now I'm just way off topic, but since I'm the first person to answer this question, I feel like if I go on long enough, my answer won't seem so bad in hindsight. But there's a thing you may be familiar with called Hanlon's razor. Occam's razor is the thing everyone talks about. Hanlon's razor I always find interesting, and it basically says, don't ascribe to malice, which can equally be ascribed to stupidity. And it's a little bit harsh, but I like it because if you think about it, in my mind, I like to think most people aren't malicious. They're not actively trying to do something to hurt someone else. Sometimes they're just doing it because either it's ignorance or they're in a hurry, or they're dumb, did something dumb, or whatever it happens to be. But that doesn't mean that what they're doing all the time is in your best interest. So you need to ask those questions.
Diversification, don't try and pick stocks. Try and go with like the standard, Vanguard ETF. I would say that it is actually jungle out there, and there's a lot more, at least sharks, than I was aware of. But maybe everybody recognizes that. I'm just in the academic bubble. But I think there has been a lack of connection between our current political state in this country and the state of white-collar crime enforcement. And I've really been aware of this. Only occurred to me, I would say, in the past year, where people look out at sort of what's going on in markets, and if there isn't back to perception that markets are rigged, or that our enforcement agencies are letting certain high-profile, shady individuals or criminal individuals off the hook, that feeds into the political element. And if you have that build over time, you eventually get to a point where the average American feels like they'd rather burn the system down than actually try and reform it, because it's not working for them. And so I don't think it's been recognized the extent to which our enforcement of our white-collar crime laws actually can contribute to the political system and to the political discourse. A friend of mine actually teaches at UT Austin, or colleague, I should say, teaches at UT Austin. And he asked his class, about the Elizabeth Holmes trial, about, how many people think she's guilty, how many people think she'll get off. What percentage of undergrads do you think believe that Elizabeth Holmes will get off and won't face any prison time? 50%. Right. And he reported that if you ask those that didn't say, prison time, how long? Less than a year. So that I would say is representative of how cynical the upcoming generation is. And if anything, I think if you asked older generations what percentage, it would be, even higher would think that she would get off. And I think that informs people's political leanings on, so I think if you want to start changing the narrative politically in the US, you have to start changing law enforcement.
I think a lot of investors today, they read the news headline and they can think about US-China as in competition, and it's about taking sides, right? Do you believe US is going to be a growth driver and you should continue to be overweight US? Or do you go, no, US is, there's so many reasons for the US to sort of lose its competitive edge, and therefore, China is where you want to go. I think that's unnecessary, right? China and US are going to be in this co-opetition for a long time. They need to collaborate as two of the biggest, growth drivers, and they'll compete. They're trying to sort of compete for more business, more consumer, more user. Business model is going to compete. The talent's going to compete, and that's going to be good for global prosperity. And given that China, in some ways, is more decoupled from the US than ever, right? It's got a much bigger domestic consumption need than an export need. That it'll be uncorrelated with the US by and large. So what you want to bet on both, not bet on one or the other. You can bet on both and let the negative correlation give you a smoother ride as both find ways to succeed, and then they're going to succeed differently, right? Very different political environment, very different part of the growth curve that they reside. So I would say, diversifying across the two greatest growth drivers in human history is the likely way to find success in your portfolio.
We have asked our closing question many times, but one thing we recently realized is that we have never answered it ourselves. We figured there's probably no better time than this episode to change that. Here's the one lesson Jack and I and Matt Ziegler, who co-hosts the Education of a Financial Planner podcast with us, would teach the average investor. Yeah, so if I could give one piece of advice to your average investor, your average active investor, someone that is managing their own portfolio, it would be think about the people that you love the most. Maybe it's your wife, maybe it's your children, maybe it's your parents, but that group of people. And then think about what they might say about you as an investor, like if they were writing your investor obituary. Did you save when you could? Did you invest it prudently? Did you take a long-term time horizon? Did you pay attention to fees? Did you do the things that were best for your investments over time? I think if you think about investing that way, that will always be sort of your North Star guiding light to bring you back to asking yourself, is my portfolio and investments done in such a way that I think the people around me would be proud of? A lot of times it's the mistakes that we make as investors that can sort of blow us up. Just this past weekend at the Berkshire Hathaway meeting, Buffett was talking about that. He was actually talking about, success in business and life. And so this idea really isn't original. It comes from Buffett, but he was talking about your obituary at the end. What do you want people to say about you? And if you sort of think of it that way, you can lead a successful and purposeful life and investing career. And he also related it to mistakes, saying that, what you want to do is you want to try to avoid those costly mistakes. So you want to be able to stay in the game as long as you can. And so I think if you think about your own portfolio that way, I think that's very powerful, and it will bring you into alignment when things start to feel like they're getting out of aligned, or if you feel like, there's decisions being made that maybe aren't the best for you in the long run.
I'm going to have three here, but they all really relate to the same thing. My lesson would be humble, be willing to change, and think in probabilities. One of the things I look at in my career is when we first started Validia, we launched these models based on Benjamin Graham and Warren Buffett, and we had these quant models, and we started them in 2003, and so that was a year that probably was one of the best years ever for that type of model. And so I thought I was like the smartest guy in the world. I didn't realize there were other things driving, what was producing those huge outperformance numbers over the S&P. I thought it was me, so I thought I was a lot smarter than I was. And so that's something I've kind of taken with me for the rest of my career is, I always try to be humble and to understand that, what I think I know may be very different than the reality of the situation. So I always try to look at the other side. I've written articles over the years challenging my belief in value investing, and that's an exercise in trying to do this. Trying to say, all right, I think I'm really smart, but let's see about how I can be wrong. And that kind of plays into the next one too, which is the willingness to change my mind. I'm a big believer in value, and I always have been. But it's really hard when you're a believer in something like that to look at the evidence on the other side. And so, all of us have this in our political beliefs, and it carries into investing as well. As you want to be able to look at the opposite arguments of yours, and you want to actually be able to take them seriously. And it's hard for me to say as a value investor if I'm actually taking them seriously, because I still believe in value. But I think it's really important to give a really hard look to things that sort of contradict your beliefs. And the more core the beliefs are to you, probably the more important it is. And then that ties to the thinking and probabilities thing. If you had talked to me 20 years ago and asked me, what are the odds value is going to outperform over, say, a 10-year period, I would have given you something like 100%. Now I think more along the lines of, well, that might be an 80-20 type thing. And so it's really important to understand that, even if you have a really strong belief, there's always probably a percentage on the other side that you're going to be wrong. And the more you can live in that percentage on the other side, and the more you can look at the arguments for the other side, I think that the better an investor you're going to be. So my general rule would be humble, be willing to change, and think in probabilities.
The one lesson I'd want to teach the average investor is that we can't talk about markets without also talking about marketing. Markets are the place people show up. You have buyers, you have sellers, you're matching to make the transaction. Marketing is the act of persuading someone, ideally with an idea that solves their problem, the opposing party's problem, someone else's problem. So when we talk about markets and we talk about buying and selling, we can't ever think about buying and selling without first thinking about the buyer persuading the seller and the seller persuading the buyer. And it's this unique relationship that there's always a story, there's always a problem that's supposed to be getting solved that we have to understand. And that comes before we apply frameworks like valuations, like why would someone sell here but someone else buy here? Or why would nothing clear at these prices or everything wants to clear at these prices? Because that's also how we understand when something's being sold to us. So if there's a product, it's deconstructing what's the narrative behind the product to understand how we're being persuaded and if that truly solves our problems. And whether we're doing macro and we're looking at broad markets, or we're doing something very micro and deciding if we should buy a product or service, making sure we always ask what's the marketing perspective on anything we do before we engage in a marketplace. That's the most important thing for any average individual beginning investor to understand.
Thanks for listening to this episode. And thank you to all of our loyal listeners and all of the great guests who have taken the time to talk to us. We look forward to many more great episodes in the future. See you next time.